All right, guys. Today is the rate hike decision from the Fed. It's going to be dropping in about 45 minutes or so, give or take here. You guys ready? Let's do this. Can y'all hear the music? Let me know. Let me know if you're ready. Can y'all hear the music? Let me know. All right, guys. SPY doing okay today. SPY got up to 404s. Pretty green day on the market here. What do you guys think we're going to get? How many basis points? All right, we're going to do a poll here, again, as we always do. Bitcoin. Hey, yeah, Bitcoin, pump it up. We're going to do a poll as we always do here, though. Let's get it started. How much will the Fed? How much will the Fed raise rates today? We got 75 basis points, 50 basis points, 25 basis points, something else. Comment below. Got the poll going. Let us know what you guys think regarding the poll. SPY testing 430s or 403.80s. It's time. Only 134 people here. Bro, we started like a minute ago, bro. We started a minute ago. Yeah, you're early, dude. We started like a minute ago. You know, we got 150 now. Within 20 minutes, we'll have, my guess is 500 to 1,000 people here. How many basis points are the Fed going to raise rates? We'll see. We're going to do a poll on Twitter, as we always do. We're going to do bullish or bearish. And then we're going to do neutral as an option as well. All right, guys. So we got our poll on Twitter going live right now as well. I'll get a timer going up here now that I figured out how to use yeah, hold on. Let me get this going here. Hold on. All right, yeah, that's working. All right, hit the like button while you're here. Vote on the poll. Let me know what you guys think. We got a Twitter poll as well. Bro, I'm putting anything out that is less likely outside. Yeah, so here's the reality of it. 100 basis points is less likely. And so we're going to just put something else. Let me know. Here, we're going to put the timer up. How close is this timer? This timer is actually pretty spot on. Put that in the corner. There you go. There's the timer. Hey, nice. What should beginners do? Get flat. That's what beginners do. Get flat. Beginners should follow me on Twitter. That's what I'm saying. At Beginner Trades. Yeah, Bitcoin pumping up. Timers for when the actual announcement's made. All right, guys. What's the market going to do? Looking at our poll, we got 72% of people think we're going to do 50 basis points today. 11% think we're going to do 25. Let me take my shoes off here, bro. I just went to the gym. I'm going to take my shoes off here. Ugh. All right, guys. It's time. No, we haven't been live all day. We just went live again. I went to the gym. 75, 100. Are you gonna open up a micro mini position? No, not for this, bro. You know. Again, I'm getting pretty flat ahead of this. I don't see any point in taking super polarized like big positions ahead of this stuff. It's just not. It doesn't make sense. It just doesn't make sense. You know. All right, guys. So SPY up to 403.80s here, bro. I need some caffeine in my life, bro. I just got back from the gym. I did too, man. How's the Fed rate? How you gonna affect the stock market? It's gonna affect it drastically. All right, here's the reality of it. 75 basis points will be almost a certain drop in the market, almost a certain drop. 50 basis points is pretty neutral. It'll be what most people are expecting, what most analysts are expecting. So we do 50. It's arguable what we're going to do if we show 50 basis points. Some people think we're going to go up. Some people think we're going to go down. Some people think we're going to go sideways. If we do 50 basis points, 25 basis points will almost certainly make the market go up. 25 basis points is going to be considered better than expected because 50 is what's expected, right? So if we do lower than expected, that means the Fed is more confident in the economy. longer term. And so if we do 25, market's probably going to go up. Anything outside of that range, if it's 0, market's going to fly up. If it's 100, market's going to crash down. That's basically what we got right now. And again, nobody knows what the Fed is going to do. Y'all be careful. All right, guys. SPY up to 404s here. The Dixie is at 103.60s. Last FOMC 143-point drop 6 minutes after Powell's speech. Yeah. All right. So the reality of it is, okay, so the rate hike decision matters. Okay. But most people think we're going to do 50, right? So most people think we're going to do 50. The reality of it is the basis point matters, but the press conference matters just as much. You know, what Jerome Powell says, again, say we do 50 basis points, it's pretty neutral. The decisive catalyst is going to be the press conference and what Jerome Powell has to say, whether he's optimistic, whether he's bearish, whether he's bullish, whether he, you know, is feeling confident about inflation for 23, or whether he is just scared of inflation. You know, and if he is, then the market's going to come down and he's going to say some negative things and people are going to panic and the market's going to drop. Right now, the market's doing okay, though. So we do have a little bit of wiggle room, I guess I would say, with everything. We do have a little bit of wiggle room. So we'll see if we get anything good, but yeah. I'm bullish, to be honest. You ever know press conference matter, just like my guy says? Yeah. Divided opinions everywhere. Yeah, but the U.S. is always broke. I mean, Kevin O'Leary testified at the Senate hearing and said Binance intentionally put FTX out of business. Even CZ is like, Kramer, get away from me, bro. All right, guys. So SPY bouncing up. It's at 404s here. We got time. You can see the timer. We got about 30 minutes, 29 minutes to be exact. Really, we got about 31 minutes. We got about 30 minutes. So actually, this timer is pretty spot on, bro. All right, cool. Yo, man, what's up, guys? Huge crash coming? I don't know, bro. I hope not. I hope we get a good result. I hope we get 50 or less. 50 or less is what I'm hoping for, bro. But I really don't know. 50 or less. Let me look at our polling here. We got some polls going on right now. Again, we got about 62% are bullish on our Twitter poll out of hundreds of votes so far. 29% are bearish. 9.1% are neutral. Looking at our actual YouTube poll, we got about 650 votes. 65% are 50 basis points. 21% 75. 13% of 25, and only 2% think we're going to do it something else. The rate hike is going to be announced at 2 p.m. Eastern Standard Time. If the market rallies, then Powell will do 25 basis points. Yeah, I mean, it could happen. I'm not saying it's likely, but it's possible. You know, I'm not saying it's not going to happen. It's possible. Market pumping up, though, ahead of this. We're at 404.50s right now. 404.50s here. Yeah, I think 50 will probably 50 is the most likely. That's for sure. So like 50 basis points is probably going to happen, but anything could essentially happen here. We don't really know. 50 is the most likely though. The speech starts at 2:30. The actual rate hike is at 2. So we got about 28 minutes, 27 minutes until the actual rate hike announcement, and then the press conference is at 2:30. Is the way it works. What's the best time of the day to buy, sell for swing trading strategy? I don't know, man. I buy in pre-market, or if we get some really big drops that I think are profitable to buy into at the opening bell, I buy into those. But yeah, look at the market pump up. We're at 404.50s right now. Let's see if we can continue. Yeah, but Klaus, to be honest, man, a lot of people were telling us that, you know, the last month we were going to go down, and we've gone pretty up. Like if you look at the SPY over the last 20 days here, you know, we're slightly green over the last 20. And so it's like you had people telling me we were going to go down and up and down and up. Like none of it matters. Most of the time, people that are really pushing the bearish agenda are just holding put option or and are desperate for us to go down. I'm not saying that's you, but like the majority of people that are really like, you know, people are dumb unless they think if they think we're going to go up, you know, are usually people that are just really extended in put options and, you know, emotional about it. Again, not saying it's you, but that's just kind of what we get. Yeah, nobody knows what's going to happen. Yeah, I was leaning towards 75 a few weeks ago. Now I'm leaning towards 50, but I think 25 is possible. You know, 75 is possible too, though. 100 basis points is possible. It's less likely, but I mean, it could happen. What do y'all think about the Atlas trading drama going on right now? PayPal partnering with MetaMask to integrate crypto services. All right, SPY is at 404.40s. Dollar index all the way down to 103.63s, and there is an inverse relationship today for sure. You can see the market has been pumping up mostly. All right, we up to 404.50s right now, 404.50s. Bullish or bearish? I really have no idea. I want us to go up, but I don't know what we're going to get. My guess is 50 basis points and slight upward movement, but I really have no idea. Yeah, Dixie going down is good. That's what we want right now. Atlas Trading is getting charged by the SEC. I believe it's by the SEC. A lot of people are like they're they're getting charged. So, and this includes a lot of penny stock, pumpers. Including, let's go over the list. Let me find it. It's somewhere here. Yeah, so basically, let's find out what the link was. Include Zach Morris and a bunch of other people. Zach Morris, PJ Matlock, Hey Tommy, Notorious Alerts, Hugh, Laidback, Dip Deity, Ultra Calls, and a bunch of other people getting charged for basically pumping up stocks. Do you have any open positions? Yeah, I got some, but they're not really going to be wildly influential, wildly influenced positions, I should say. We're in Carvana. We're in AMC, and that's about it. We're pretty flat and everything else. Again, I don't. I'm not really taking any big polarized positions. I'll take some positions after the numbers released, depending on what we get. Like, we get big drops after the numbers released, and after the press conference, we'll start buying. The meeting's at 2:30. The actual announcement's going to be at 2. Yeah, Atlas Trading is exactly why I run the way I run it. Yeah. Yeah, that's exactly why. I have no idea what I'm talking about. I might be wildly wrong about everything I say. Speech is at 2:30. Hey, what's up, Daniel? So yeah, I'm not gonna buy anything right now. I'm not buying anything ahead of this. It's mostly a gamble trying to predict what we're gonna get. I'm not saying you can't make money buying up stuff ahead of the Fed meetings, but most of the time it's a losing endeavor and it's just a gamble. Not really losing, but most of the time it's a coin flip. It's not, in poker terms, it's not what's considered like plus EV is what they call it, like plus expected value. Like, you're not expected to make money long term doing that. It's mostly just a gamble for people who lack discipline. No offense to anybody here, but nobody knows what we're gonna get. It's all basically just a coin flip. And so if you're taking huge positions based off of a coin flip, you're probably gambling a little bit, and that's okay. Do your thing, man. I make y'all's money. I'm not mad. Maybe I'm wrong. Maybe y'all can make money doing it. Spy testing highs of the day right now. We got 20 minutes, guys. 20 minutes. A little bit under 1,000 people here. Yeah, my timer's a minute off, Patrick. We're almost real time here, so we're basically real time. Timer's a minute off, though. It's not exact. We're a little bit off. I actually set this timer earlier today. So right now it's 1:39:23. So it's about a minute off. SPY just broke highs of the day up to 405.25s right now. 405.25s. Goldman Sachs is reportedly considering a bonus cut at least 40% of the investment for the investment bank. Yeah, 50 or 25. I think we'll probably go up if we do 50 or 25. At least I hope we do. I hope we go up. We're also going to put it in sub-only mode, guys. So if you haven't already, subscribe. We do this live. Did I say subscribe? Subscribe, guys. We do this live every weekday for free right here. We don't charge a penny. My big thing is, like, I'm not an expert. I don't claim to be an expert. I don't sell anything or charge anything. We have commercials for sponsors, but, like, we don't charge for content. We don't have any paywalls behind content. I don't claim to be an expert. And so subscribe if you haven't yet. We appreciate you all. No, there's probably not a leak. Everybody always says ahead of these big announcements that there's some type of leak and that they know some secret information. They're always wrong. Always wrong. I'm not saying they're wrong this time, but, like, every time people have said we had a leak, they were always wrong about what it was, right? At this point in time, it's actually statistically more likely that they would accidentally get it right, and they still have it. And so, there's no leak. It's just people trying to influence people. That's it. How would the market react to 75 or 100? Market will go down, almost certainly, from those two numbers. Almost certainly. Hey, thank you, Abdullah. I appreciate you, man. Should we buy stop or sell stop? I mean, that's just kind of a vague question, man. There's not really any way to know. Yeah, I hope you're right, Stong, but again, it's so hard to judge, man. Somebody said yesterday 6.8% for CPI, and, like, we didn't do that. Hey, thank you, Ronnie. We appreciate you, brother. Thank you, man. 50 basis points is priced in above that would move the market down almost certainly. Yeah, 100%. All right, guys. Hey, we got 15 minutes left. 15 minutes. I will be right back. I'm going to be right back. All right, I'll be right back. Yeah, guys. So we're pumping up. We're at 405. All right, guys, I'll be back in 30 seconds. If it takes over 30 seconds for me to get back here, I'll only respond to the name Peyton as my name for the rest of the stream, okay? 30 seconds. If I'm over that, I will only respond to my name as Peyton for the rest of the stream, okay? Get ready. We're going to go at 16:15. At 16:15, all right? Ready? I'll only respond to Peyton. Ready? All right, I'm going. Whew. All right, how was it? All right, look. Did I make it? I think I made it, right? Whew. Whew. Did I make it? I had to make it. Yeah, oh, I made it for sure. Whew. All right, I'm back. I hate Peyton Manning. That's the reason Peyton was the name. I hate Peyton Manning. All right, I'm back. Whew. I think I made it. Yeah, hey. Peyton's back. I made that, man. Y'all can't even lie. Don't even lie to me, you know? All right, guys, market's pumping up a little bit. So how does this news affect the market? Well, it affects the market drastically. All right, let me catch my breath real quick, and I'll explain. All right, so inflation is bad right now, okay? So inflation is bad right now. In times of high inflation, the Federal Reserve raises interest rates in order to combat it. The reason they raise interest rates is because they raise rates in order to discourage buying, and because when people stop buying, businesses must in turn lower their prices in order to remain competitive. And so one of the ways they get businesses to lower pricing is by raising interest rates, because that discourages buying, right? That's what the Fed does, is they raise rates. During peak times of high inflation, they raise rates really aggressively. When they raise rates aggressively, again, the whole point is to discourage buying. And so there's an inverse effect between raising rates and the market as a whole, right? The more aggressive the Fed is, the less optimism they have for inflation long term, and the less buying that we're probably going to get on the short term. And so if they raise rates really aggressively, there's an inverse effect. The market goes down. People are less confident and the market goes down because buying slows up. With that in mind, the last few months, in the last few quarters, really the last year plus, the Fed has been aggressively raising rates. Right now is the rate hike decision. So in 13 minutes, they're going to announce how much they're going to raise rates. Now, since we've seen some optimistic signs regarding inflation, like CPI came in lower than expected, which is a gauge on inflation. PPI, I think, came in a little bit worse. But historically, over the last few months, CPI was better. Most of the conventional inflation gauges that we've seen were better than expected. And so with that, a lot of people are optimistic regarding this rate hike because they think the Fed is going to slow down with their rate hikes. Basically, a couple months ago, Jerome Powell basically said they were going to do a 150-point rate hike for the rest of the year in 2 Fed meetings, which would mean 75 each. Since then, he's kind of changed his tone a little bit and acted like he was going to do lesser rate hikes, right? So most analysts right now are expecting 50 basis point rate hike, which is still conventionally high, and inflation is still conventionally really high right now. But we have to look at the recent changes, and if he does 50, that'll be as expected. If we do over that, though, that means that the Fed is raising rates more aggressively than expected, and that will cause a bad effect on the market. If we do 75 or if we do 100, the market's going to tank. If we do 50, that's neutral. Again, that's what most analysts are expecting. We do 25, that's good. That's less than expected, which will cause the market to go up. All right, that's the nuance of it. Yesterday, we had CPI come in better than expected. And so a lot of people are really optimistic right now, but that's kind of the nuance of it. And you can see the dollar index. We're looking at the dollar index right here. It is down. It's at 103.50s. We got about 10 minutes, guys, 11 minutes. We'll see, Evander. I hope you're wrong, brother. I hope you're wrong, but it's possible, man. We'll see. All right, we're at 405 right now on the SPY, 405. The Squeeze app isn't working? Yeah, we're working on it right now. We're updating it. It might be a little bit, though. Bitcoin running up as well. Yeah, I see Bitcoin. Look at Bitcoin right here. We'll put Bitcoin on the right. Bitcoin ramping up right now at 18.4K. How's the gym, man? The gym was good. Didn't have time to do as much cardio as I wanted. But we got some weights done, so that's good. You know. Everybody's scared to buy a put. Yeah. Understandable. I mean, Fed does 25.50, market's going to fly. Would 25 even make sense? Might as well not raise it then. Well, no, not necessarily. Basically, Jerome Powell did a press conference a couple weeks ago. In that press conference, he basically said that he didn't want to crash the market and then play cleanup. He would rather sustain rate hikes, but not super aggressive ones, so that they could slowly ease them and slowly combat inflation without necessarily causing a crash, which is really what a soft landing is called. A soft landing is when they raise rates aggressively, but not enough to cause a recession. Now, it's arguable whether we've been in a recession or not. A lot of people are going to say we have, and that's understandable. But basically, Jerome Powell doesn't want to raise rates too aggressively. My guess is he doesn't want a market crash under his watch, and that's understandable. I get it, man. I don't want to crash right now either. At the same time, though, I'm pretty flat, so it doesn't really matter too much. All right, we're at 405 right now on the SPY, just under 405 at about 404.80s. Bitcoin's still pumping up. If we look at the dollar index here, we got about 8 minutes, guys, 8 minutes. Here's the dollar index. And there's an inverse correlation here because when inflation's bad, the dollar index is up, right? So if the market's doing well, people are going to want the dollar to drop. And if the dollar is losing value, people are going to take that and take their cash because their cash is losing value, and they're going to stick it into equities, or they're going to stick it into Bitcoin or somewhere else because their cash is losing value. And so dollar index drops, markets go up. Vice versa as well. When your cash is losing value, you take it and put it into other stuff. But if your cash is gaining value, you're less likely to invest in other things, right? So there's an inverse correlation there. And you can see the Dixie is falling down and the market has been pumping up mostly. And there's a negative correlation here. All right, guys, 7 minutes. Is today going to be a record stream viewers? Nah, man. Yesterday we had about 6,000 people here. We got almost 2K here, but I don't think, I hope we're going to break records today. I'm just going to go ahead and put that out there. I'm going to speak it into existence. Oh yeah, got you. Yeah, if y'all want to check out our Discord, guys, our Discord is completely free. We got a lot of free content. Again, my big thing is like, I don't charge for anything. I don't claim to be an expert. I don't act like a guru. Again, everything we put out there is free. And so if you want to see this, we kind of talk about all of it. We've got all these different sections. We got a voice chat, a main trading chat. We protect you from scams. We got daily movers with Pawn going over a lot of the big moving futures, options trading where we talk about options and all that stuff. And it's completely free to join. It doesn't cost a penny and we don't sell any of our content. So again, if you want to join our Discord, I'll post this link here. Great way to help support the channel. It's !Discord. You want to reach out or anything like that? Hey, nice, Ivan. Yeah, man, I'm telling you, Chart Prime's nice, man. Chart Prime works really well if you use it right. SPY dipping down here. I'm a little bit tempted to buy the dip, but we got 6 minutes until the actual rate hike decision. Hey, thank you, Thomas. Yeah, let me know if the Discord works. Somebody's saying it doesn't work, but it should work. All right, guys. So again, the SPY at 405's dollar index still testing lows, breaking down here. Less than 5 minutes, guys. Less than 5 minutes. Okay, thank you, guys. Hey, welcome. All right, guys. So yeah, the way we're gonna figure out whatever we got going on here today, let's take a look at the Federal Reserve calendar here. All right, so here's how this works. All right, so here's the Fed Reserve calendar. I'll show you basically what this is, okay? So again, we got about 4 minutes. You scroll all the way down, you're gonna see December 13th or 14th, right? So the rate hike decision at the point in time, we're gonna be able to refresh this, and the HTML. Like if we look at the last one, right? We look at the last one. You scroll down here. If you really want to analyze it yourself, you scroll down. And they show you where they raise rates to 4%, right? So they raised rates to 4% last time. You can see that right there, from 3 3/4 to 4%. And again, so we're at 4% now. And if we raise rates 50 basis points, we're going to be at 4.5%. If we raise rates, 25, we're going to be at 4.25. If we raise rates 75, we're going to be at 4.75 is how it works, right? So that's the thing to pay attention to. And again, you can look at it that way. But expectations are for 4.5%. And we'll cover it live as we always do right here. But if you want to look at it, I'll post this link too. If you guys want to see the actual site so you can interpret it yourself, here's the link right here. Again, 4.5%. There's the link right there if you want to check it out. We'll also put that link in the description here as well if you guys want to check that out too. All right, guys, SPY pump it up here. We got 2.5 minutes, about 2 minutes and 50 seconds. Really, we got about 3.5 minutes, but that's okay. Markets are moving up though. Disney up to over 95s, Apple at 146.40s, SPY at 405s. Dixie all the way down to 103.57s right now, 103.57s. $50 or $25, please. Yeah, we'll see. I'm cautiously optimistic. I want to see the market do well, you know, and so hopefully we get 50 or 25 or 0 even, you know. Yeah, hopefully we get 55 or 0. I'd be okay with either one, you know. Carlos Correa, man, what did he get? 350 mil for 12 years. All right, up to 405.08s. Again, we got about 2 minutes, guys. About 2 minutes and 2 minutes and 10 seconds. All right, you guys ready? Again, remember to hit the play button. Every time we do this, we have some people that are like, y'all are late, bro. Y'all are late. We're not late. Hit the play button. Again, hit this. Make sure you hit the live button next to the play button. Okay, hit that button. If not, you might be behind on stream. If your computer lags or whatever, hit that button right there. Okay. Two minutes, guys. Less than 2 minutes, really. About a minute and a half left. Good luck, team. Hey, let's make some money, hopefully. Hey, what's up, Antonio? All right, we're at 405.30s, 405.30s on the SPY. SPY pulling back here. We got about a minute and 15 seconds. Yeah, y'all hit that like button, guys. Run those numbers up. We got about 2,700 people here. What's your record viewers? About 6,000 or so simultaneous viewers, you know. Yeah, if you're in a large position, you're braver than me for sure. You know. All right, guys. SPY pull it back a little bit short term. Less than a minute. Less than a minute. We got everything ready. Again, 4.5% is what they're expecting. If it's at 4.5%, it's going to be a 50 basis point rate hike. Anything outside of that, we'll cover it. But 4.5% is what's expected. We got 30 seconds. Yeah, we're going to cut that. All right, guys. 20 seconds. 20 seconds. 10 seconds. This one might take a little bit longer to get to. 3 seconds. Here we go. Here we go. All right, market dropping. Market's dropping. Let's refresh. It's not out yet. Waiting. Market's down. 4.5%. It's on par with expectations. It's 50 basis points. It's 4.5%. 50 basis points. On par with expectations. It's 50 basis points. So the Fed raised at 50 basis points. And the press conference is at 2:30, guys. Remember, the press conference is at 2:30, but it's 4.5%. Market is not liking that reaction. And again, I told you guys, 50 basis points was the most likely outcome here. 50 basis points was the most likely. So this is technically neutral. This is what a lot of people thought. This is what a lot of analysts expected here, 50 basis points. So on par with expectations. We're going to put this number up on screen. And yeah, market is down. Market is down. Yeah, Dixie's flying up. But again, I mean, this reaction doesn't mean much. It's 50 basis points. What matters the most right now is that in 30 minutes, we're going to do Jerome Powell press conference. Jerome Powell press conference. If you want to see what they said here, let's look at what they said. So here is the actual report here. It said recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broad price pressures. Russia's war against Ukraine is causing tremendous human and economic hardship. The war and related events are contributing to upward pressure on inflation and are weighing on global economic activity. The committee is highly attentive to inflation risks, and the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to raise the target range for the federal funds rate to 4.25% to 4.5%. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Basically, in determining the pace of future increases in target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. Is strongly committed to returning inflation to 2% objective. Basically, same thing they've been saying. Now, market is falling down. We're at $400 right now. $400 on the SPY. And again, the press conference is in a couple minutes. So the press conference is going to be in a couple minutes, and we are going to be streaming that live here as well. So be ready for that, guys. Be ready for that. All right, you guys ready? All right, so the press conference again, guys. The press conference again is going to be in 25 minutes, 26 minutes to be exact here. All right, so SPY bouncing at 400. Dixie moving up to 104. And what matters the most at this point in time is going to be the tone of the Fed. It's going to be the tone of Jerome Powell. Okay, they're going to interview him. He's going to do a press conference about this. And what matters the most right now, considering that we came in on par with expectations, is what his tone is like, what he sounds like, what their opinion on current inflationary pressures are, and what their plan of the future of 2023 is. That's what's going to matter the most. That's what you really want to pay attention to and watch moving forward, is because Jerome Powell's tone is going to mean a lot right now, and it's something to really pay attention to and watch. Yep, Fed raised by 50 basis points according to Yahoo Finance. Yep, I mean, that's what it was, 50 basis points. Read, it might say it right underneath me, guys. It might say it. Again, we'll see if we can hold $400 here. Here's the SPY at 400. And get ready for the press conference, guys. Again, get ready. This is going to be the interesting part. Also, just a word from our sponsors. If you want to check out Top Step and you want to trade these big economic releases, if you look at the E-mini on the right, and then you look at this, it's the same price action. You can see it's the same exact thing. And you can trade this right side here in the futures market with no PDT restrictions. You can day trade short it with a margin account, no PDT restrictions. And if you want to get your feet wet in the futures market without risking a bunch, try out a funded account program like Top Step. It's the most legit funded account program in the world. They give you a demo. If you can hit the target on their demo while following their rules and conditions, then they fund you $50,000 up to $150,000 with a 90% split. You take that funded account, you make $10K, you keep $9K, they keep $1,000. Regulated by the Chicago Mercantile Exchange. They pay out millions, fund thousands of traders a year. If you want to check it out, they are a sponsor of my video. Here is the link. The press conference starts in 25 minutes exactly. 25 minutes exactly. Santa was invested in FTX. Yeah, I'm staying flat right now. Again, I'm waiting for Jerome Powell to speak. I think that's the most important thing to watch right now is what he says. That's going to be, man, the sun is getting on me. That's going to be the more influential thing right now because we came in as expected here. We came in at 50 basis points. And so we came in as expected. And so the big thing to watch right now is what Jerome Powell says during this press conference. And again, we are going to be streaming the entire press conference live as we always do. Stick around. You're a mean one, Mr. Powell. All right, y'all be ready. You guys, y'all be ready. All right, SPY is at 401s right now. 401s. We got the E-mini at 4,045s. If you look at the dollar index, the dollar is loving this right now. The dollar just ripped up here to almost 104s. Tapped right at 104. Market's starting to bounce at 400. Again, this is a neutral reaction. And the drops that we got right now, they're not super substantial. Like, they're not huge. Again, they're somewhat meaningful. You know, we're down, to $400. but they're not catastrophic by any means. What matters the most is what Jerome Powell says during this press conference. Let me know what you guys think. We're going to end this poll, and we're going to do another poll right now. All right, SPY pull it back to 400.5. So Dixie pop it up a little bit. This is, again, there's an inverse correlation here. So if we move up on the dollar index and the SPY falls, that's generally what's going to happen. The SPY is going to fall. We're testing 400 right now. Let's see if we actually hold this. Yeah, Dixie just broke high. SPY under 400s. Yeah, I mean, these aren't the biggest moves here. I mean, like I said, I mean, are they small moves? No, but we're only slightly break even on there. We're only slightly red on the day for the SPY. You know what I mean? So it's like, it doesn't mean much right now. What matters the most is what Jerome Powell says. You know, I'm not saying he's going to say good or bad things. I really have no idea. But is this drop good for markets? No. But is it terrible? No, not really. It's again, it's a neutral reaction. If you look at the market in the last 90 days, we're pretty close to flat. We're down a little bit. If you zoom in a little bit here and you look at the last 20 days, we're pretty close to flat too. So what Jerome Powell says during this is going to be important. We also have jobless claims numbers tomorrow, and then next Friday we have the PCE deflator that'll be relevant also. All right, guys. So yeah, Disney at 93.40s. We got the SPY down to 399s. All crypto drop. Yeah, what's Bitcoin at right now? I know Bitcoin was up to 18K ahead of this. Bitcoin's at 17.9. The drop's not that bad for Bitcoin either. What's the Q at? Here's the Q. It's down to 285.90s. Good or bad things for Jerome Powell press conference? Good or bad, guys? We're going to end this poll. We got about 3,400 votes. We're going to do, does the market react positively or negatively to the FOMC press conference? Let's say positive reaction, and then we'll do negative reaction. Vote on this poll. Neutral reaction. We'll leave that one there too. All right, vote on that poll. We got that poll live as well here. Q pushing down. SPY still under 400. Again, 20 minutes, guys. 20 minutes before the JP press conference. Is it a good time to buy right now? I'm not buying anything yet. There's too much unknown right now. So, like, I'm not buying up anything yet. Again, personally, myself, I'm staying pretty flat until we get something that looks good. You know? Disney bouncing back. SPY bouncing back to test 400. Powell's trying to keep the market neutral. Yeah. Isn't 0.5 good? Why is it crashing? Not necessarily. 0.5 is neutral. You know, but I think with a lot of hype, like I saw a lot of bots and people posting, it's leaked, we're going to do 0, you know, or it's leaked, we're going to do 25. And I think with all that hype, you know, it kind of, the bubble gets burst a little bit. 50 is neutral. It's what's expected. You know, if you look at most major analyst sites, you know, it's what's expected right now. And again, you can kind of see we're bouncing back. We're back over 400. We're at 400.5, roughly where we were in pre-market today. You know what I mean? So it's just kind of like, we're pretty neutral. I mean, we got a neutral reaction, or we got a neutral rate hike and somewhat of a neutral reaction. I mean, we obviously reacted negatively, but are we in crash and burn territory? No, not yet. We'll see. Let's watch the dollar index. The dollar index is a little bit of a tell on what we're getting right now as well. You can see the dollar index ramp up. We're starting to pull back on the dollar, and you can see the SPY start to bounce back a little bit too. I can put the S&P 500 up here as well. Would y'all rather the SPY or the SPX? Here's the S&P 500 right here on the left. So there's the S&P. We're over 4K. Yeah, I didn't think we were gonna do 0. Again, people were mad I didn't put 100 basis points. People were mad I didn't put 0 on the poll originally, and I told them it was just not super likely that we were gonna get those. Again, most of the time we're as expected in terms of basis point rate hikes. Like most of the time we're as expected. CPI we can change. There's a little bit more variance with CPI, PPI, economic releases like that. But in terms of the rate hike, it's pretty. There, you know, usually the big banks are right. Yeah, it was 50 basis points. Y'all do me a favor, hit that subscribe button, guys. Help me hit 95,000 subscribers. We're really, really close. We're at 94.5K. Help me hit 95,000 if we haven't already, guys. We do this live for free every day. We don't charge for any of it. We give everything away for free. The dollar popped up a little bit. We might get a drop on the S&P 500 now. You see the dollar index move up. We at the S&P 500 dipping down a little bit. I believe Powell will say good things. Short or long during the J. Powell speech? Ooh, I don't know, man. We'll see. I hope long, but like I don't know, man. Again, it's very difficult to figure out what he's gonna say. You know, unless you got insider info, it's gonna be hard to judge, man. That's it. I'm subbing him. Hey, thank you, team. Big fan of what you do with these live streams. Hey, thank you, Aaron. I appreciate you, man. Thank you, sir. Yeah, I mean, we just try to give people a free resource and community. And with all the craziness going on with Atlas trading right now, them getting charged by the SEC, again, I'm very, very happy I ran the channel like I do. You know, I don't sell anything. I don't claim to be an expert. I don't act like a guru. I don't pump penny stocks. I don't even really talk about pennies that much. I definitely don't pump low floaters. Always tell people I don't know, have no idea what's going to happen. You know, I always tell people I have no idea what I'm talking about. Do not copy me. And in hindsight, I'm glad I did. I'm glad I run it like this. Dollar index pumping up. We got the SPY and S&P 500 falling back down some. I think Friday will be a good day to pick up shares because I'm expecting some weakness. Maybe, man. Friday, I don't think we have any release Friday. I know next Friday we have the PCE deflator. But right now, tomorrow we have jobless claims numbers, so that'll be interesting. We got the retail sales. So yeah, tomorrow we got retail sales too. So that'll be interesting as well. SPY testing 401 right now. S&P 500 testing 4010s. So tomorrow we got some stuff happening. Friday, let me see. I don't think we have anything Friday going on. Friday we have European CPI early in the morning at 5 a.m. So early in the morning. Dixie falling down some too. That'll probably make the SPY pop up. But yeah, Friday we have European CPI, Eurozone CPI at 5 a.m. Nothing else really going on. Yeah, Friday be pretty, small day for economic releases. Next Friday's big though. I mean, my favorite movie was Friday though. You know, Smokey. Next Friday was good too though. I like next Friday. I like next Friday as well. Let me know what your favorite one is in the chat. Dollar index is pumping up a little bit. We're at 103.95s. Watch this $4,000 level in the S&P. We can also look at the SPY itself and look at like 400. I'm a little bit more familiar with the SPY over S&P, and I know it's a little ironic because the SPY follows the S&P, but watch $400. It's just a psychological level. Yeah, that's what I'm saying. Next Friday is when that is, Stelios. Friday after next with Day Day. Now, Day Day is in next Friday. And Friday after next. So Day Day actually is in next Friday as well. Oh yeah, it's quad witching day. Friday is quad witching day. It's when all 4 major contract types expire. Index futures, stock futures, stock options, and index options. Those are all expiring on Friday. Right? So the quad witching day is Friday. So that'll actually be a pretty big day relative to normal Fridays at least. Alec, I'm Powell's wife. I got insider info. Hey, listen, do you, man? Quad witching day, yeah, 4 charts. All right, guys. Hey, we got the press conference starting at 12 minutes. 12 minutes. Yeah, I always wanted one of those dogs from next Friday. I can't remember what they're called, but those dogs, man. All right, guys, dollar index is popping up a little bit. We're slightly over $400 on the SPY. Again, pretty neutral reaction. We'll see what JP has to say, guys. Let me look at the poll here. We did a poll. Yeah, we're going to stream it. Yeah, we're going to stream. We stream every day. We stream all the major economic releases. We will stream the press conference, like for sure. We're going to stream the press conference. We always do. So yeah, don't worry. We're streaming it. We got 11 minutes before it starts, though. See if they put the stuff up here for the press conference. But yeah, we're going to stream it. Don't worry. All right, guys. Dixie falling back down. SPY popping up a little bit. All right, guys. Let's get ready. Waiting here, guys. Waiting. You gonna broadcast the press conference? Yes, we are. We're just waiting. 2:30 Eastern time. All right, guys. SPY under 400 is now back over 400. It's testing that level now. Another quick word from one of our sponsors. Check out Chart Prime, guys. This is why Chart Prime is pretty unique here. Is because because it gives you really nice signals. Let me show you guys some examples of Chart Prime and like why it's useful. Okay, so again, what Chart Prime does is Chart Prime shows you, it's a trading view indicator service. So it shows you it automatically documents support and resistance. You can see it automatically documents support and resistance here. But what it also does is it shows you, it has a predictive algorithm that shows you possible reversals up or down. It automatically documents candlestick patterns as well, right? What I like to do with this, and this is a sponsor of mine, they got a huge sale going on right now. But what I like to do is I like to find multiple at once. You can see a bearish engulfing candles, multiple show up at once. Look at the nice little drop you get afterwards. A possible reversal up signal and a bullish engulfing candle. Look at the nice bounce you get afterwards here. And so if you find multiple that show up together, it can be powerful. It really can be. Again, it's called Chart Prime. It's a trading view indicator service. Look at the possible reversal down and bearish engulfing. Look at the nice little drop you get afterwards. And again, even on this here, guys, so even on the latest rate hike decision, look at this. 2 bearish engulfing candles, got the drop, possible reversal up, got the bounce here. And so again, it's called Chart Prime. It's a trading view indicator service. They got a huge sale going on right now. They are a sponsor of mine, and so I'm definitely biased in their favor because, again, they pay me money. But if you want to check them out, here is the link. Great way to help support the channel. Waiting for the press conference to start here. We got about 8 minutes left. 8 minutes, team. Name of the background music? Yeah, y'all can hear the music, right? The music's playing, correct? Yeah, it'll be interesting here. Again, we're testing that $400 level. And so we're testing that level now. We'll see if we actually hold, but we're right around that $400 level. We'll see if we hold it. Again, you can see the dollar index here starting to pump up a little bit. Let me make this a little bit smaller until it starts. Shout out to everybody that's helping us grow, bro. Look at this. We got 55,000 views over the last 48 hours. So we're averaging 26,000 views, 26,500 views a stream or a day, you know, about 13,000 over the last 60 minutes. So shout out to you guys. We appreciate the love and support, guys, for sure. Hey, thank you, team. What makes Friday quad witching day? So Friday is quad witching day is the day in which all the major contract types expire. And so that includes stock stock options, index options, stock futures, and index futures, right? So all 4 major contract types in the market expire on the same day. It's the 3rd Friday of the month, right? Which is tomorrow, or which is the day after tomorrow. You know, the first Friday was the 2nd, second Friday was the 9th of December, and then the 16th, which is Friday, will be the 3rd Friday of the month. Again, it's the day in which all 4 major contract types expire on the same day. Generally speaking, it's a day that we've seen big volatility. We don't know what's going to happen, but generally speaking, we get a little bit added volatility on quad witching day. That's what quad witching is. Hey, thank you, Ronnie. Hey, thank you, Thomas. Just found your stream earlier this week and love it. We'll definitely be back here for big news, but hey, thank you, brother. We appreciate you guys. Hey, all good, fish. Yeah, happen 4 times a year. What's up, Chris? Yeah, here we go. All right, guys, listen, we got less than 5 minutes here. So probably a pump from witching day, maybe, bro. I don't know. Like I said, I have no idea what we're going to get. Nobody does. Anybody that tries to claim that they know exactly what's going to happen doesn't. Look at the dollar index fall here. So look at the dollar index fall, and then we got the SPY bouncing up a little bit. We're over 400. Again, we're in between 401 and 400, about 400.5 right now on the SPY. And again, we'll see if we actually hold these levels. Same here. First time watching. The value is great. Hey, thank you, man. Hey, what's up, Thaddeus? Yes, sir. We're growing, man, for sure. Yeah, it's funny. It's like we got people that show up to the stream, and they show up at like 6 a.m. And they're like, bro, this dude's got 80,000, 90,000 subscribers, only 200 people here. It's like, bro, it's 6 a.m., dude. I told him, like, watch, join us for the CPI day. We had 6,000 people here. We got like 30,000 plus views, right? That's a huge percentage of my overall subscriber base, you know? So it's like, we're doing pretty well. You know, we're growing pretty nicely. And hey, I appreciate you guys. Thank you guys so much. Cheers to you guys. I always got mad at my dad for drinking Diet Coke. You know, I always got mad at my dad for drinking Diet Coke, but like, look at me right now. Dad, I'm sorry, man. Listen, I get it now. I understand. All right, guys. Dixie popped right back up. We're at 104s Right now, 104 is just underneath it. Hey, thank you, man. Hey, I appreciate the sub, guys. Nah, I'm good, bro. I don't know what I'm talking about. I have no idea what I'm talking about. Mega. I have 100K. Help me trade. Listen, you don't want to. I mean, listen. I don't sell anything or claim to be an expert. I'm not an expert. I'm not even claiming to be a good trader. You know, we're just a resource and community. Hey, what's up, P? Why don't you change your name, bro? Like, I can't even say your name. I appreciate the $5. Thank you so much, but change your name, bro. I'm just gonna have to call you P for now. You know, I can't even like share that. I can't even put it up on screen, bro. You know. All right, guys. Hey, we got 2 minutes, 2.5 minutes. Bro, changing your name is easy. You go to your page. But no, I appreciate it, though. Thank you, man. I appreciate it. Call him PP. Yeah. Peyton. Call him Peyton. Dollar index followed down. We're at 103.90s here. We got about 2 minutes left. 2 minutes, guys. Quad P. Hey, that's a good one. Why is it necessary what JP says? It's not necessary. I mean, he's just going to, again, everybody, economists, market people, we're all watching what Jerome Powell says. Everybody's kind of hanging on every word he's going to say. And it's going to influence the market heavily, depending on his, opinion on how good or bad inflation is currently. I mean, it's obviously bad, but how bad it is what everybody's going to be watching to see. All right, guys. Yeah, we got 2 minutes. QP? Yeah, that's good. Always expect the unexpected. Yeah, I guess so. All right, guys. SPY at 400s. We are waiting for them to start. We are completely live here. Again, waiting for them to start. We'll see if we get something good here. Let me know what you guys think. I'm watching this at 3:30. Feeling sleepy. Hey, after this, get some rest. I appreciate y'all being here, though. He is the voice for inflation, and inflation affects the market 100%. Yeah. Buy stocks. You should definitely change my name. All right, SPY up to 400.5s right now. Disney at 93.60s. If Disney drops enough, I'll buy Disney right now. Disney just makes so much money that it's hard not to buy it. All right, guys. SPY up to 400.6. Dixie falling down at 103.80s. Why is Lucid falling to death? Because it's an obscure EV company. And most obscure EV companies are going to fail, regardless of how much hype they have. I hate saying this. I know a lot of people are invested in them, but again, most people don't know about them. Like, take Polestar, Mullen, Rivian, Lucid. A large majority of the population has no idea what any of those are. And if they had to buy an EV brand, they'd buy Tesla or like Toyota or one of the big boys. They're not going to buy an obscure EV company and risk looking like Rusty Griswold. You know what I mean? All right, guys. Here's the press conference. Sound check. Y'all can hear, right? Everything's good. Y'all can hear with sound. You should be good. I'm going to make this a little bit larger. There we go. Waiting. Silence. Sound is good. Okay, cool. All right. Market's getting volatile ahead of nobody's even said anything yet. So you can see the SPY on the left side right here. Here's the market. Yeah, the OG, Rusty Griswold. All right, here he comes. All right, guys.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Thoughts, guys? Thoughts?
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows again that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilek, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE, core inflation index, is non-housing related core services. And that's really a function of the labor market largely. It's the biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed? Well,
I'll tell you what the projection is. I don't think it would qualify as a recession, no, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision, but that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Nick.
Thanks, Nick Tamaros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that had come out last week, do you think it would have changed?
Came out yesterday, actually.
Forecasts in today's SEP?
No,
CPI was
absolutely
yesterday.
No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks. Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now we've continually expected to make faster progress on inflation than we have ultimately. And that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
So it's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really. As of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP, but futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. And we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Chris.
Hi, Chris Rugaber, Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year. So that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index. And it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving, down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Kate.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether in the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient, we think, sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a, so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't, and this is the best we can do. I do think though that and markets are pretty confident. It seems to me that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Grady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in the economy? Are you monitoring?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from Market Watch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about getting Congress action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned. If you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market? Are you looking for a job or have a job? And you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually. It's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because, they gave us a job and we need to, do that job.
Thanks. Jennifer?
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things, but that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, that we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that would mechanically happen like that. It'll be a test of, for cutting rates, I think in the event, it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
All right, guys. So that is what he said. Market is basically completely neutral right now. I mean, and so the big thing for people to understand right now, I'm pretty sure that's everything. Yeah. So the big thing for people to understand right now, and this is really, really important. Understand this, guys. We got a neutral rate hike decision, a neutral rate hike decision. So the rate hike decision was 50 basis points. That's what everybody expected. I see a lot of really polarized viewpoints in chat. I see a lot of people saying, oh, the market's going to fly. Oh, the market's going to crash. We are completely neutral right now, completely neutral. Just to put this into perspective, guys, here is the previous closing price, right? So here is the previous close. Hold on, let me reset this here. Here's the previous closing price right here. We are literally at the previous closing price. What does that mean? That means we're completely neutral. Don't sensationalize it. That's the reality of it. Neutral for now. Yeah, we don't know what we're going to get leading forward, but we're neutral for now. But yeah, guys, we're going to be doing a crypto show. And so literally as soon as we end the stream, it's going to bring you straight to our crypto show. Check out TopStep. TopStep is the most legitimate funded account program in the world. They pay out millions, fund thousands of traders a year. And if you want to trade these big economic releases, look, here is the E-mini, right? Here's the E-mini on the right. Here's the SPY or the S&P 500 on the left. It's literally the exact same price action. If you look at the S&P 500, it's the exact same price action as the S&P 500. And you can trade this right side in futures with no PDT rule. TopStep funds traders. And so they give you a demo account. They give you a paper account. And if you can hit their target while following their rules, they fund you between 50 to 150,000 with a 90% split. Great way to test yourself. It builds you into being a better trader. The base package is less than $140 a month. If you use my link, you can check it out. Great way to help support the channel. Again, it builds you into a better trader. And if you're good enough, you can get funded. So again, check them out here. Good luck, guys. Love you all. Y'all stay safe. Check out Chart Prime as well. Chart Prime is a trading view indicator service. And so what Chart Prime does is they do custom trading view indicators. So really useful, man. Like I had a lot of people talking to me today, talking about how good Chart Prime has been for their trading here. And if you look at the SPY, for instance, right now, again, this gives you custom indicator alerts. So it tells you bullish, bearish, engulfing candles, all that good stuff. And again, it's just really, really useful. Like, look at this. So you can look at this and see multiple bearish engulfing candle alerts, possible reversal up, and it'll give you automatically document support with resistance. It'll give you reversal down signal. Look at the drop, 2 bearish engulfing candles. Look at the drop, possible reversal up. Look at the bounce. And so pretty accurate, guys. It's called Chart Prime. I'll post this link as well. Great way to help support the channel. We are going to be moving over to our crypto show, guys. So we are going to be streaming a crypto show. You can find all of these links in the chat. Thank you guys so much for all the support. We're almost up to 95K. We're at like 94.5, 94.6K. And so listen, we don't charge a penny for any of our content. All the content we put out there is free. I get so many people reaching out to me saying, hey, John, if you sold a course, we could get rich. I don't want to sell a course. I want to give everything out there for free. I don't even claim to be a good trader. I'm just putting it out there for free. You know, hit the subscribe button. That's all you could do. The easiest way to support the channel. Again, we're going to end this stream. And as soon as we end it, we're going to go over to our crypto show. We're going to be doing a crypto show today. And so y'all be ready. We're going to be covering Sam Bankman-Fried getting arrested and a lot of other stuff, guys. So be ready. We're closing down now. If you don't get reverted to the crypto channel, it's youtube.com/beginnercrypto. Check it out. Here is the link just in case you do not get reverted. There is the link. I appreciate the love and support. And yeah, we're going to do our crypto show now, guys. So be ready. We'll see you guys over there. Later, team. Starting our crypto show right now.